Hello and welcome to the Global View on this Wednesday. Well, US labour costs increased in the third quarter amid strong wage growth. The employment cost index rising 1.1%, increasing 1% in the previous quarter. And annual US home price growth accelerated for a third straight month in August, up 5.6% on the year. The Federal Reserve is expected to leave interest rates unchanged when it reveals its policy decision tomorrow, as a recent surge in US Treasury yields and a stock market sell-off have tightened financial conditions. Longer dated US Treasury yields are little changed as the Fed meets. The yield on the 10-year note at 4.87% and the 2-year up to 5.07%. And inflation in the Eurozone continues to fall while the economy is contracting in response to tighter monetary policy. Prices rising 2.9% in October, their slowest pace since July 2021. The euro little change while the US dollar index has risen and the Aussie dollar trading at 63.4 US cents. And the yen has dropped to a 15-year low against the euro after the Bank of Japan said it would keep the 10-year government bond yield at around 0%, set under its yield curve control, but redefined 1% as a loose upper bound rather than a rigid cap. Well, around 78% of US third quarter earnings results have exceeded consensus EPS expectations. To examine US earnings trends and a view on gold also, we're joined by Michael Cooey, Portfolio Manager with Kennedy Partners Wealth. Michael, great to catch up with you. Thanks for joining us at ausbiz. So I see you point out that those prints have been strong, but forward guidance remaining poor at this point.
Yes, Andrew. First of all, thank you for having me on your show. Forward guidance has been a little bit weak, but when you look at the earnings setup for this quarter, it's actually being strong, as you touched on earlier, at about 78% in terms of beats on earnings. However, investors are looking at the reason for those beats. And when they look at the top line, which is on the revenue line, there have been misses, which means that the companies are actually not getting as much pricing power as they initially have been in the past. Where that earnings has come from is from margins. And so we've seen a margin expansion story that's really kicked off since the start of the year, really playing through now. And so the companies that are able to protect their margins have demonstrated strong operating modes. And so investors are incrementally positive over there in that setup.
All right, I guess it begs the question though, if there is a new earnings downgrade cycle, and in fact, let's take a look at those EPS revisions. We've got a chart.
Sure. So for the start of the year, we've had this kind of revision on EPS growth just because investor sentiment has been extremely bearish. But what we've seen this earnings cycle at the moment is that the cyclical sectors are having a bit of a revision to the downwards. And so capital goods, consumer services, and US home builders. And so we are beginning to see that the EPS revision cycle has started to revise to the downward. Now, the consensus expectation for full year 24 is still around 12%. At about a $250 EPS target for the full year 24 number. And so we still believe that's a little bit optimistic, but that's mostly driven by some of the tech earnings that we're seeing at the moment, where we're seeing multiple compressions actually have started to come down and actually earning expansion start to look through a little bit more stronger there. Just on that point, on the US tech side, in terms of strong balance sheet versus good balance sheet, that's been an extremely strong trade at the moment since start of the year, and we continue to see strong operating leverage coming in for some of the larger tech companies. Year-to-date performance for the tech players, especially NASDAQ, is about 30% up year-to-date. You marry that across with Magnificent Seven, there being strong attributions to that. However, we are seeing a very narrow leadership for the course of path forward, and so for the next quarters, we're expecting really 3 to 4 companies to lead the charge there, Andrew.
Yeah, and of course, the background of this is what we're seeing with those Treasury yields at the moment, certainly at the longer end. Talk us through that and the likely impact then, Michael, on earnings going forward. I guess particularly the focus being on those mega cap tech stocks.
Yeah, sure, Andrew. When you look at the relative performance of the tech sector this year, given where yields are at in the 2s and 10s, it's truly unprecedented. And I think part of that is due to the fact that a lot of these companies are very free cash flow generative. And so these companies have strong operating leverage and have strong margins and also good earning visibility, which I guess investors are looking to pay up. And so historically, the inverse trend is high yields, lower tech, because they're a very duration centric sector. But due to the fact that a lot of these companies have had this AI tailwind, but also what we're seeing is pricing power. From an earning visibility standpoint, they are still best in the house at the moment. And so we're seeing these companies having almost a re-rate from a more pro-cyclical standpoint to a more defensive lens. And so that's something that investors have started to really shift their, I guess, narrative away from the traditional very inverse correlated yield curve, whereas now people are actually crowding into these tech companies because they are strong cash flow generative, strong balance sheet, and also when you marry the AI and enterprise spend in the cloud, these companies will be here for very much longer because they've turned out their debt and also have good visibility there.
Can you just unpack this chart here? So this is the 30-year yield.
So this is the 30-year yield married with the large cap tech indice. And so we're seeing the fact that these companies are actually going in tandem, which is really, really extreme because historically it's been an inverse correlation. And so what that means is investors are looking beyond this kind of short-term yield price action that we're seeing, especially in the bear steepening side, and actually crowding into these tech companies. And so I believe the current crowding that we're seeing in the Magnificent Seven, as I touched on earlier, will become more and more extreme as the path goes forward.
Now, Michael, of course, we look at the macroeconomic background and also those geopolitical tensions, what's playing out in the Middle East at the moment. And we have seen investors obviously option for those safe haven assets, gold in particular. How are you viewing gold right now?
Look, Andrew, gold is something that's been topic of mind, inbound wise from investors. It's not something that's being well loved traditionally because it doesn't pay a yield and it's very hard to discount from a cash flow perspective. That chart there on the screen shows that advisors are very, very underweight gold. And this has been something that's been secular trend for the last 10 to 15 years. Obviously, the data there shows the last 5 to 6 years. We believe this current geopolitical climate, we're talking about high interest rates, geopolitical uncertainty with the Israel-Gaza conflict, furthermore married on with a potential recessionary risk, do make gold incrementally positive. Now, what's happened to gold in terms of price action is since early last month, gold rallied about 8% from $1,800 an ounce. Two parts there. One part was driven by a short covering narrative. Investors were too negative and bearish positioned ahead of time. The second part was mostly driven by actual buying. And so people are starting to add length in terms of volume towards gold in the belief that perhaps there is going to be a future global uncertainty happening. And so we are very much in the camp that the gold narrative will play through, and I think as a byproduct of that, from an Aussie gold miner perspective, a lot of these gold miners will have strong free cash flow generative opportunities as well.
Did you have any sort of key levels in mind with the gold price?
Yeah, I think the $2,000 per ounce is a very, very big psychological barrier, and we've tested that overnight, and we've tested that a couple of times. I think we'll continue to flirt with that level as the time goes by. I'm also looking at the AUD equivalent, and so we are looking to break all-time highs. We've broken about 3,100 last week, and so from Aussie miners, those are key levels that continue to surprise to the upside.
When we look at the miners, Michael, it's certainly the larger producers that have benefited thus far. At the smaller end, certainly among the explorers and developers, they haven't moved. Is it your expectation that they will eventually?
That's correct, Andrew. And I think what we're seeing in the large cap space, led by Newmont and Newcrest last week, has been quite extraordinary. And so the flows are showing that perhaps there is more consolidation to come in the large end. But to your point around the small and mid cap in the explorer space, we're seeing a lot of opportunities there. And there's been corporate interest. There's also been a lot of new discoveries. And one of the discoveries that we're looking at quite closely and have a position in is a company called Spartan Resources. The company market cap is $350 million. They have the Never Never deposit, which they're drilling out, looking to build around the existing resource of about 720,000 ounces. We're looking to build that number out to 1 million ounces. At current spot price of 3,200, looking at a perhaps all-in sustainable cost around that $1,600 to $1,800 per ounce will give them a really, really good free cash flow generative margin there. And we believe where current market cap is a multiple turns lower than where we're actually valuing the current expected value there. So,
Michael, terrific to get a view of your strategy there at Kennedy Partners. Well, thanks so much for joining us.
Pleasure. Thank you, Andrew.
And that is the global view for this Wednesday. Stay with us. Open just around the corner where we are expecting a higher beginning. Stay with us.